Well, this topic is about the optimum capital structure, and it follows the discussion on factors influencing capital structure. As the name suggests, it's about the components of an optimum capital structure. Well, by the word optimum, we mean balanced, and that's what we discuss even here. It's basically the discussion of a balance between debt and equity in the capital structure. Balance does not mean a 50-50% composition of debt and equity. It primarily means a balance such that it gives it results in a balanced risk and return of the capital. It also results in maximum wealth for the shareholders, which typically means highest possible price per share of the shareholder. It also leads to a low cost of capital. That's what is a balance between debt and equity primarily means. All these elements are very important for a capital structure to be optimum. Any external financing involves risk, and it comes with an expectation of return from the investors. So there has to be a balance struck between risk and return, such that uh, uh, you know the company is able to gain maximum returns with minimum possible risk. It should also lead to maximization of shareholders' wealth, which may necessarily not mean increased price per share all the time, but increased earnings per share for the shareholders. It also means low cost of capital, as in less cost to the company. What are the elements of a sound capital structure? Well, it should be simple to understand. A complex capital structure is very difficult to follow. So the simpler it is, the better it is for execution. Profitability, it should focus towards profitability. It should take care of the solvency of a company, and the solvency typically means um, the capacity of a company to pay off all its obligations at any point in time. Flexibility, it should be such that if it requires change, because capital structure is designed keeping in mind certain projections into the business. So those projections can change during the course of the business. So the sound capital structure demands that it should be flexible enough to be changed during the course. Conservatism, it primarily means that there should not be, it doesn't mean that you should not project in a good you should not project optimistically in the business, but at the same time it means that you should factor in all possible losses or all possible slip outs into the business while the plan is getting implemented. Control, the sound capital structure also ensures that the company does not lose control over the business, so that the final say into the management of the company is of the company and not of the creditors. That's what it means by control. Equity, we have been talking about the combination of debt and equity in the capital structure since the last slide. In fact, since we started understanding the concept of capital structure, so this does not need a more discussion than what we've already done. Value maximization is also in a way related to wealth maximization. The value of a company is equal to the value of its capital structure, and hence the aim of the company should be to maximize its value, to design its capital structure in such a way that it maximizes the company's value, because with value maximization come a lot of benefits for the company. One is the investors confidence, of course, which is very important for the company to survive, and also the capability to face the competitors. Well, that's about the sound capital structure. More in the upcoming slides. Thanks.